Okay. Now, this policy is not a normal life insurance policy. Okay. What happened and allows us to do this is in 2020, because of COVID, there was a lack of money in the bond market. Okay. Insurance companies put money in bonds. Okay. So in order to correct it, Congress passed a law. And these are the laws right here. Okay. 7702101A. In this law, they are allowing people to put 3 times as much in an insurance policy as ever before. So what I'm showing you next is a confluence of events and things that happened. Okay. But I'm going to compare first the terms and conditions. We all know what a savings account is, but let's compare it to a line of credit. Okay. So line of credit is, of course, governed by the banking laws. Insurance policy by the Internal Revenue Service. And one more thing I just want to say. So this is an index universal life policy. It's not a normal policy. It is uncapped. So if any of you guys have index universal life policies, you know that it can be capped at 9% or 12%, which means that you can get up to that amount from the S&P. It is indexing the S&P 500, not invested in, which means it's giving you the ups only. This one is uncapped. Also, they have a floor at 0%. You cannot lose money. There is no risk. So this policy gives you the death benefit. It gives you living benefits. So if you have a stroke, heart attack, cancer, you can take 90% of the face value and use it while you're alive. Okay. So there are inherent advantages with this policy. So again, the insurance contract is the collateral. A line of credit is a recourse loan. If you don't pay, they're going to collect. They're going to try to get that money. Here, it's non-recourse. How do you qualify? Credit, income, collateral. Over here, your health. Is it reported to the credit bureau? Yes. If you pay well, you have good credit. If you don't, you have bad credit. Over here, not reported. You have a monthly payment due. Here, yes, there's always a monthly payment due on a line of credit or a credit card. Over here, no minimum payment. Can it be canceled? Yes. So over here, I said no, but I just explained to you why. If you put in $563,000 and you take out $563,000, no big deal. The collateral pays the loan, right? If you take out $1 million and you close or cancel the policy, everything you take out above the 563 is now taxable. So that's why we say no. Okay. Again, if you lose your money, if you lose your job temporarily, then you can't make a payment. They are going to chase you and call you. Over here, it's non-recourse. There is no minimum payment due. If you lose your job permanently and you can't make the payments, they are going to chase you until they can't get the money. They're going to write it off, and then they file a 1099 and it becomes income, and the government is going to then want their money. Okay, so as we can see here, the terms and conditions of these two, the life insurance is by far the best. So now I'm going to show you where I'm going with this. Okay, so let's reshare. So I can make this a little larger for you guys in case you can't see it, or for you are on a phone. Okay, what you see here is called an arbitrage. Thus, that's why the name arbitrage. Okay. And what it is a banking spreadsheet. This is how the banks calculate the spread on interest. So in other words, they pay interest, they charge us another amount, and they make the spread. Okay. So let me set this up for you. Okay. This is a couple who had bought a house for $350,000 with interest. And I'm going to go low. Let's say they were going to pay $150,000 in interest. So they were going to pay $500,000 over 30 years. They used our debt GPS technology, and it eliminated $100,000 in interest and had them paid off in 7 years. They were 40 years old when they got started. So they paid off their house now, and they're 47 years old. What they did, again, is they didn't use a savings account. They didn't use a line of credit. They used the policy that I just described to you guys. They put $400,000 in the policy. And there was one thing that I did leave out about the policy. That is, it is liquid. It is just like a savings account. Has the same characteristics. So in other words, they can put 400,000 in, and the insurance company is allowing them to borrow 95% of the money. They can borrow the money. So let me grab my pen here again. Sorry. At 4%. However, the policy is indexing the S&P 500. And we have a couple of different policies, let's just say, but let's go with Credit Suisse. Credit Suisse, let me do that again, has yielded for the last 18 years, 7.26%. Okay, over the last 18 years. An actual return, not average return. So they are now debt-free. They put $400,000 into the policy, and they borrowed $400,000, and they paid their mortgage off in 7 years. So here they are in a great position. They use the technology. Okay. At 47, they can close the policy. The $400,000 gets paid by the collateral. So 400 liability, 400 in collateral. They're debt-free in a great situation. Okay. So they borrowed the 400,000 at 4%, but the insurance company is allowing them to become their own bank. They can continue to borrow the spread at 95% of it. It is continuing to be liquid. So here they are. They cancel it, no big deal. But if they keep the policy open, so they're done at 47. Let's look 5 years or 3 years in the future. Okay, so they're paying 4% on the money, and their cash value is indexing the S&P. We have another one that's been over the last 3 years at 8.5%. Okay, so what you're looking at is, some of you guys may have heard of infinite banking. This is turning infinite banking on its head, right? Infinite banking, they fund the account or the life insurance policy by making premium payments. We're taking their debt. Okay. They, in infinite banking, use a whole life policy, and there's a couple problems with that now. It used to be a 4% guarantee. Well, they changed it. It's now 2%. So a 2% guarantee. Okay. This is indexing the S&P. It is outperforming 401ks and IRAs, right? And the big thing about it is everything you take out of this policy, it is tax-free. So now, 3 years later, they owe $466,000. It's growing by 4%. However, their collateral has grown to $521,000. Okay. So they are now liquid $54,000, and they are their own bank in a non-recourse position. So as a bank, they're going to take the money out and put it on the street. They get to borrow that amount, 95% of it. And now they are spending the money they used to pay off their debt again. Okay. So here we are. They've now taken out 51,000. They borrowed 51,000 and they now owe $518,000. So 518 to 83. Whoops, 83. Okay. And they are 50 years old. They are never going to pay the loan back. They're never going to take the money out of the policy. They're going to continue to borrow. All of the money they take out is tax-free. So at 50, if they pass away, the loan gets paid. If they had $1 million policy, then the family gets the rest of the 500 or the rest of the million, and they've enjoyed 51,000. However, at 55, they now owe 662,000, but in their collateral side, cash value, they have 779,000. They are now liquid $117,000. They're a bank. They're going to take the money out and they're going to send the kids to college. They're going to buy another home. They're going to put a swimming pool in their house. It doesn't matter how big the debt gets, because the bank is never going to, the insurance company is never going to allow you to take more money than you have. Okay, so now they owe 773,000. 773,717, and they are 55. They do not have to wait 5 years. I just don't want to show every year. The money never leaves. They can borrow it as they please. But at 55, again, the collateral pays the liability. Here, 60 years old, they now owe 988,000. However, they have 1.1 million in their cash value. So they are going to borrow. Now they've spent $329,000 during their 12 years or 13 years after they paid off their mortgage early. Okay. And now they owe 1.1 million. 1155041. And they're 60. So at 60, again, the liability gets paid by the collateral. If they passed away at 65, then their family gets to 261,000, and they've already used 329,000 tax-free. But they're having fun. They got plans. They are $261,000 liquid. They are going to borrow it. Now they're more than $500,000 they have to spend during their retirement, later years, after putting the kids to college. They've got money continually coming in, tax-free. As long as the policy stays alive, they continue to reap the benefits. So at 65, they now owe 1.7 to 4,300. So here they are, 65, and the 1.7 liability is paid by the cash value, 1.7. If they pass away at 70, Okay, they owe 2.2, but in their cash value, they have 2.5. They are now $390,000 liquid. I would pull the money. They're nearly $1 million that they've added to their retirement by paying their mortgage off early and putting the money into the insurance policy and borrowing it. So at 70 years old, they owe 2.5, a big amount, 74116, and they are 70. At 70, the liability gets paid by the cash value. If they passed away at 75, family would get 582,000 on top of the million, almost $1 million they pulled out already. But they're happy. They got things to do. They're going to borrow it. They've now added $1.5 million to income and retirement. 75, they owe 3.8, 3842, 762. And they are now 75 years old. 75, the liability gets paid by the collateral. At 80, they owe $4.9 million, big number, but they have 5.7 million in their cash value. So they're going to borrow it. Do you think they ever imagined before doing this that they would actually add $2.3 million to their retirement? The numbers continue to grow. Of course, we're not going to go with 111, but you can kind of see where I'm going. So this is what hybrid mortgage arbitrage is, guys. We are helping people retire with dignity.